Good morning, students. Welcome you all for the fourth session of the first unit, Risk Analysis and Investment Decisions of the subject Advanced Financial Management. The topic covered in this session is a simple problems. We are going to do simple problems on the risk-adjusted discount rate approach. Here, the objective of this session is to make students able to evaluate the investment proposals using RADR approach. In previous class, I have dealt with the techniques of measuring risk. There are various techniques which are classified into mathematical model and non-mathematical model, like RADR approach is there, certainty equivalent approach is there. In non-mathematical model like decision tree analysis is there, sensitivity analysis is there. So those in detail we will study in upcoming sessions. And in risk-adjusted discount rate approach, we have dealt what is the meaning of risk-adjusted discount rate approach, what are the decisions, how to accept and reject the project, and also the merits and demerits of the RADR approach. So RADR approach means it is a method of estimating the risk of a project by adding the risk-free rate and risk premium. We are estimating the cash flows by discounting with the RADR, that is risk premium plus risk-free rate. So let's discuss some simple problems on RADR approach. Question goes like this: a project is required to invest 1 lakh. The project is required, the investment for the project is 1 lakh and is expected to generate, the project is expected to generate cash flow after tax. It is its economic life of 5 years, means the economic life of that project is 5 years, and the cash flow in each year is 20,000, 30,000, 35,000, 55,000 and 10,000. Risk-free interest rate is 7%, that is the interest rate which is quoted on government securities, where you are not taking any risk and your principal and the return is very safe. That rate is 7%. If you are going to invest in some government securities or bank, that is you are getting 7% without taking any risk. Now in this project you are taking some risk, so you need to add some 3% as risk premium for the project, and then you need to discount it. You are required to calculate NPV, that is net present value, using RADR approach and suggest whether the project is acceptable or not. So the solution goes like this: a project calculation of NPV, it requires discount rate. So in the previous session I said the formula to calculate RADR is equal to risk-free rate plus risk premium. So in problem they have given risk-free rate is 7%, and premium is 3%, that is 7 plus 3 is equal to 10%. So RADR, risk adjusted discount rate, is 10%. Now we need to calculate NPV. So we need to make in a table, first years 5 years, another is CFAT, that is cash flows after tax, which is given in the problem, 20, 30, 35,000, 55,000, 10,000, and a discount factor, that is 10%. How this 10% is arrived? Here 7 plus 3, that is 10%. That we need to take, we need to refer the table and we need to find out at 10% what are the discount factors, that is 0.909, 0.826, 0.75, and for fourth year it is 0.683 and 0.650, that is present value interest factor, from the table at 10%. So we need to multiply this. 20,000 into 0.909 is 18,180, 30,000 into 0.826 is 24,780, 35,000 into 0.751 is 26,285, 55,000 into 0.683 is 37,565, 10,000 into 0.650 is 6,500. We need to add all these values. It comes to 1,13,310. That is the total present value. In that total present value, to get the net present value, we need to deduct cash outflow. In the problem they have given the cash outflow, here it is 1 lakh, that we need to deduct from the total present value. So our net to present value is 13,310. In the previous session, while accepting or rejecting, what criteria we are adopting is that In case if you are calculating through NPV technique, we need to accept the project if NPV is greater than 0. So NPV is 13,310, which is greater than 0. So project is acceptable. It's very simple problem. Let's go to second problem. A project costs an initial investment of 40,000 and it is expected to generate annual cash inflow of 16,000 for 4 years. Means 16,000 is same for 4 years. 16,000, 16,000, third year also 16,000 and fourth year 16,000. The project's RADR is 20%. The risk adjusted discount rate is 20%. You are required to calculate IRR, that is you need to calculate internal rate of return. You are using the internal rate of return technique and suggest whether the project is preferable or not. So here we are using trial method to arrive. We are doing trial method in internal rate of return. We are doing by trial method. So fake payback period, that is the formula to calculate payback period is cash outflow divided by average cash inflow. So 40,000 divided by 16,000, within 2.5 years only we will get this 40,000. That is fake payback period, that is outflow divided by average annual cash inflow. So this is 2.5. Referring to the table of present value of annuity of 1 rupee table, we find that this fake PPB 2.5 lies between which rates? 21%. In 21% rate we are getting this 2.54 and in 22% rate of interest we are getting 2.494. This 2.5 lies between 2.54, that is 21% and 22% in the row of 4 years. In the 4 years we are getting this 2.5. So present value of cash flow at 21%. Present value, we need to discount the 16,000 at 21%. That comes around 40,640 and present value of CF at 22%, that comes around 16,000 into 2.494, that is at 22%. So the amount is 39,904. So to calculate IRR, the formula is A plus C minus O divided by C minus D into B minus A. So what is A? A is the lower rate of interest. Lower rate, what we are taking those 21 and 20%, that A is lower rate of interest. So 21% plus C means it is present value of lower rate of interest, that is 40,640 minus O means it is outlay, that is cash outflow, divided by C, again C means it is a present value of to lower rate, that is 40,640 minus D means it's a present value of higher factor, that is 22%, that is 39,904 into B minus A. B means higher rate minus lower rate. So 21 plus 40,640 minus 40,000 is 640 divided by 40,640 minus 39,904 is 736 into 22 minus 1 is 1. So 21 plus 640 divided by 736 comes around 0.869 into 1 is 0.869 into 1 is 0.869 plus 21 is 21.869. So our calculated IRR is greater than cutoff rate, that is cutoff rate is 20%. So we need to accept the project. Thank you. These are the problems based on RADR approach. Thank you.